Indians love biryani. It was the most ordered food item on the Zomato app in 2022, with customers ordering 186 biryanis every minute during the year. It was the same for Swiggy, with 137 orders placed every minute. While pizzas and ravioli also found favor with Indian taste buds, given the substantial volumes generated by just biryani, it comes as no surprise that Sher Khan expects India's overall food delivery market to clock a compound annual growth rate of around 12%, to reach about $18 billion by FY25 from about $10 billion in FY20. This should leave Zomato and Swiggy, which have formed a settled duopoly in the market, salivating over the prospects of growing their revenues and even becoming profitable. But it appears that at least one of them has realized that this won't be possible without changing its playbook. On April 28th, Swiggy started charging users a platform fee of 2 rupees, regardless of the order size, in a bid to generate additional cash corpus and rein in expenses. Being levied on users from Bengaluru and Hyderabad at present, this fee is likely to be extended to other regions soon. At the moment, it is applicable only on food delivery orders and not on orders on Instamart, Swiggy's quick commerce arm. And while Zomato has not introduced any such fee, Business Standard has reported that it is keeping a close watch on how customers react to Swiggy's move. As of Q4 FY23, Zomato dominates the segment with a 56% market share compared to Swiggy's 44%. And the gap is expected to widen further by the end of FY24. The development also comes after Swiggy saw its losses more than double during FY22, even as its revenue jumped over twofold. Its net loss widened to over 3,600 crore rupees for FY22, owing to a sharp spike in expenditure. Meanwhile, Zomato reported that its net loss widened 50% to over 1,200 crore for FY22, and its revenue from operations more than doubled to almost 4,200 crore, while total expenses also more than doubled. In its Q3 FY23 earnings release, Zomato said that there was a good chance it could reach adjusted EBITDA break-even, excluding quick commerce, in Q4. Meanwhile, a financial daily reported in February that Zomato had approached several restaurant chains seeking a rise of 2 to 6% in commissions. But restaurant operators had refused to accept the hike. This reported move and Swiggy's introduction of a platform fee are an indication of where the unit economics of the online food delivery business stand in India.
These players have been in the market for more than 7 to 8 years, and despite that, they are struggling to get a big profitable margin, right? So I think there are clear concerns. They are trying to increase platform fee. I believe that is a measure. But broadly, if you look at the unit economics on a per order basis, they make close to 110 rupees on a per order basis, which is a mix of delivery charges and the restaurant commission that they get. The major cost herein is the delivery charges, which is about 60 rupees per order, which they pay to the delivery person. And then there are other costs, in terms of customer acquisition, discounting, and the tech of the platform or the user experience rather. So I think it seems to be in a very pressed environment right now, wherein the restaurants are right now refraining to increase take rates. Delivery charges obviously can't go up because order values are very small, close to 400 rupees. So they're trying to basically, be innovative over here, trying to, take maximum out of the customer and trying to charge them, from a platform fee perspective.
Indians are also increasingly embracing quick commerce, which involves 10 to 30-minute deliveries. But even as consumers flock to instant delivery platforms, profitability is nowhere near on the horizon. BharatPe co-founder Ashneer Grover said that the 10-minute delivery model was plagued by low ticket size and low margins and had no economics.
Instant commerce is all about a better customer experience. It's about sweating your existing assets that you've already invested in, doing that a little more efficiently. So it serves other purposes. It's not primarily to make money. Instant delivery is going to be a loss leader. One has to very cleverly use it in the portfolio to achieve objectives of customer experience and maybe driving more customers into the proposition.
Coming back to online food delivery, what can foodies like you expect going forward?
If you look at food delivery, there's no return over there, but the per order cost is very high in terms of delivery charges that you pay to the end delivery person. Your order values are very low. So if you look at retail, fashion, these business order values are 1,050 rupees per order. Here, the order value is only 400, 450. So there's very little to be made, by the platform. So I'm saying there are going to be innovative ways in terms of when the customer will be asked to pay in the form of delivery charges, platform fee. It could be lowering of discount. It could be in the form of membership. I think these things will keep on evolving.
The Indian customer will come to terms with some of these incremental charges, because what is the alternative? The alternative is that many of these services might shut down, right? If they don't have a profitable business model, right? And hence, I think practically Indian customers do understand it, but they will register their protest every time there's a price increase.
Ultimately, the likes of Swiggy and Zomato may have to look at new means of monetization. And some of those new avenues may involve the consumer shelling out more for their beloved biryani. However, the impact on our wallets won't be too large, because both companies know that India remains a price-sensitive market.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.